Good afternoon, ladies and gentlemen, and I should say good morning to those of you who are in the Central Time Zones and the Mountain Time Zones and the Pacific Time Zones U.S. as well. I also perhaps should say good evening to any of you who are joining us from across the pond, maybe in UK or in Europe, and also good early morning to those of you who might be joining us in Australia. My name is Mike Chupka. I'm the Director of Education here at Power Options. I believe Kurt's going to be joining us in just a few moments. He put together a new presentation for us to go through the ideas and concepts of bulletproofing the portfolio, a simple 5-step program to remove all fear of losses while still positioning for outsized gains. And this is going to be new to me as well. I haven't actually gone through all the slides yet, so we're all going to learn something together. And at the end of the presentation, I'm also going to go through about 12 or 15 slides of a recent position that I have. Kurt mentioned in the morning email that's bulletproof now, guaranteed gain of 18% or so, and we'll be reviewing that. All right, but let's go ahead and just get started, and we'll wait for Kurt to come in and join us any moment now. And the first thing I want to do before we jump right in is I just want to ask a quick poll, launch a quick poll here. And what I'd like to know is just what is your experience with radioactive trading? Are you just focusing on the free materials right now, taking advantage of the sketch, maybe some of the YouTube videos or some of the archive presentations? Are you currently thinking about buying the blueprints? That's Kurt's full methodology that describes his original RPM setup, which we're going to talk about today, and of course also from the RPM setup, the 10 different income methods that can be used to bulletproof a position. Or do you already own the blueprint and are here to review some of the finer points of the strategy and some of the techniques as well? So just let me know what you're hearing. I'll leave this open for about another 10 or 15 seconds. All right, we've got a lot of our votes in, and this is an interesting split that we're seeing here. Let me go ahead and close those results, and I'll share the results with everyone that's online right now. We have 48% of our attendees are joining the free materials. 23% are thinking about buying the blueprints, and 50% of us currently own the blueprint. Well, fantastic. There's going to be some review here as well as some introductory materials. I just had a question pop in. It looks like Mohammed. He's going to apologize. What exactly is the blueprint? Well, before we jump into the full introduction here and the next steps of the process, the next steps of the presentation, Mohammed, what we're discussing today is the radioactive trading technique that was developed by Kurt Frankenberg. It is a unique form of the married put setup to help us enter into limited risk positions. Off of that setup, we're going to be able to launch 10 different income methods to pay for the initial at-risk, bulletproof the position, and then earn extra income. Now, the blueprint is Kurt's full work, Mohammed. It describes his steps for entering the positions and what he looks for when he's opening a new radioactive profit machine. And then from that point, we're going to launch the 10 different income methods. That's fully described in the blueprint. And Joe just popped in and said 121% response is interesting. You can answer more than one on this. So of the 48% who are taking advantage of the free materials, an additional 23% of those 48%, or part of those 48%, are probably thinking about buying the blueprint there, Joe. So that's why we have 121%. Now, let me go ahead and hide those results, and we'll just go back to our basic slide presentation.
Hey, Mike, are we there?
Yes, Kurt, we're here. We already launched our first poll, and we're getting ready to go into the new presentation.
Happy day. Well, we couldn't have a new presentation without some kind of glitches, and it's what happened on my end. I'm so glad that you were able to get us started. So very good. Well, have you introduced everybody?
No, I have not started to do that, Kurt. I just launched the first poll, and we're just getting ready to move on here to the quick intro.
Okay, well, here's what I want to do. I want to mention to everybody to get the most out of today's presentation. Please hold your questions to the end, and that'll help save Mike and me with having our fingers going. Generally speaking, when Mike's talking, I'm typing, and when I'm talking, Mike is typing. But if you can just hold your questions till the end, it's very likely that your question will be answered by the course of the presentation itself. Okay? And if not, then we'll make sure and address it. Okay, if you participate in the polls and the prompts, that'll help us to help you and also guide the presentation. Okay. Pardon me. Quick introduction. My name is Kurt Frankenberg. I own a martial arts studio. I have since I was 18 years old. I'm now pushing 43, and so it's going to be my 25th anniversary, and pretty excited about that. Along the way, Mike, you know that I got involved in trading covered calls and spread trades, and I promptly lost everything. So we're going to go into that introduction here pretty soon. Let's give an introduction about you.
As I mentioned at the beginning, my name is Mike Chupka. I am the Director of Education here at Power Options. Power Options has been in business for over 13 years now. We are a patented search and analysis tools that support over 23 different option strategies. And we got connected with Kurt about 3 years ago. He was a customer of Power Options and wanted to know how to use the back testing to review some of his techniques that he's applying into the market that we're now all familiar with. And since that time, I joined Kurt for a couple of his free presentations that he was doing at the time. And I've been trading the radioactive technique in my personal account for the past 2.5 years now.
Very good. Let's see here, Mike. Let's go ahead and just launch into this bugger. And all right, this is our first in this webinar today. I'm going to make a bold promise, okay? And the bold promise goes like this. I'm going to show just something really simple, and it's a principle that that I found that all successful traders had in common. Mike, I was researching the lives after I lost everything. I was researching the lives of great traders and found that they all had different ideas on what kinds of investments to pick up, what kind of timing to use to get in, what kind of signals, and also what kind of hold time there ought to be. They all had completely different ideas, but this one simple truth is what they all had in common. And after I share it, I think I can confidently claim it will improve your trading. Okay, let's go to the next slide. They've often said this truth, okay, but without the practical directions on how to achieve it. Now here it is. Are you ready for this? Cut your losers short, let your winners run. That's pretty simple, isn't it? Okay, cut your losers short, let your winners run. And that's exactly the one thing that they've all had in common, that they've managed their money very tightly according to very strict rules. But very often do we do that. Let's hit that key again. Okay, does it sound familiar to everyone? Type yes if that sounds familiar. Okay, we'd just like to see that. Type yes if you've heard that saying before. Cut your losers short and let your winners run. The question is, do we always do this? Not so much. Okay, Bill says yes. Joe says yes. We've got piles of folks answering yes. Okay. Leadvin, nice to see you. Gunter, Paul, yes. Okay, we've heard this, but we've never heard, or we've rarely heard, the practicals on how do you do that. Exactly how do you do that? What does that mean? Cut your losers short, cut your losers short, let your winners run. Well, here's my promise. I'm going to show you a practical, workable, and reliable way to put it to work. It'll instantly improve your trading results if you just do what we're going to share. It will instantly improve your trading results. Okay, let's go. This simple formula is now being used in over 25 countries. Mike, the other day I typed this out and then I went and counted. The countries. There's 32 countries around the world that that we've shipped the blueprint to. And it's kind of remarkable because the blueprint costs in the range of $300. Okay, it's right in the range of $300, and yet I've had a number of people tell me that, hey, you taught me more in the first few chapters than I learned in these weekend seminars. It cost $3,000. Now, Mike, what kinds of seminars am I talking about?
Well, there are several seminars out there that you can pay $2,000, $3,000 for the weekend to learn how to trade maybe covered calls, maybe trade vertical spreads, maybe trade calendar spreads. And you learn just enough to become dangerous, in my opinion. You learn what the setup is, you learn about the technique, and your mind is filled with a promise of, hey, just trading covered calls, you can easily make 3 to 6% per month on a regular basis. Or you can leverage that doing calendar spreads, and you can make 8 to 10% per month on a regular basis. What's never addressed is the fact that you're still risking potentially 100% of what you invested in the position. When I'm doing a calendar spread, sure, I'm leveraged. I bought a call and sold another call, so I've got a minimal cost basis, but I'm risking 100% of that. And if I do a covered call, hey, it sounds great. Let me rent out my stock to someone and get 3% per month. Until the stock drops 10, 15, or 20%, and you realize the stocks that moved up, that you guessed right on, that moved up 10 or 15%, got called away from you for only a 2 or 3% gain. Meanwhile, you're holding positions that are down 10, 15, or 20%. That's not addressed. You paid $3,000 to learn how to potentially have a sorting machine set up in your portfolio.
All right. Hey, Mike, we've got a problem with the audio. It looks like we've got a few of our attendees that are unmuted, and we need to make sure that we're muted. Hang on just a second.
No, I'm showing everyone's muted there, Kurt.
Okay.
So I think we're fine there.
Might be a feedback issue because I'm actually doing this on 2 computers, so we'll just shut one of them down here. That'll take care of business.
Mm-hmm.
Hey, listen, folks, does what we're talking about sound familiar? Have you been promised this 3 to 6% per month, or have you found that seminars that tout covered calls and spread trading and so forth cost in this range? And did you maybe come away not having the answers that you needed? We're having a couple of folks answered. Richard's asking a question about the blueprint. Richard, please do hold those kinds of questions till the end. Okay. Yep, Richard says, yes, they cost that much, and they do. Bill says, yep. Mm-hmm. Okay, Philip, affirmative. All right, been there, done that. Did you buy the T-shirt also, Ken? All right. Well, let's go ahead and take a look at what's available. But as we're doing, I'm going to tell you a quick story. Okay. And I'd also like to know. Might go ahead and hit the next frame. But I'd like to know what kinds of options trades we're doing now. Okay. What kind of options trades are we into at this point?
Kurt, if you can, we have a couple of attendees joining in saying that your volume is a little bit low, or maybe mine is a little bit too high. So you may want to check that and adjust it if you can.
You know what I may do is I may just call in. That could work a little bit better. Let me sign off here real quick, and I'll call back in, okay?
Okay. All right, so we've got the poll going now. And I'm going to leave this open for another 10 or 15 seconds. So it looks pretty much similar to what we see during these polls here. Looks like covered calls is leading the way, but you have a lot of spreads and or condor traders as well. Excuse me, ladies and gentlemen. So this is working out pretty well. I'm going to leave it open for about another 5-10 seconds. I apologize. And then we'll go ahead and close that poll, and I'll continue on with the presentation here. All right, let's close that down.
Bingo. Hey, I'm in. Can you hear me okay now, Mike?
Yes, sir. Mm-hmm.
Okay, and let's hear from our attendees. Can you guys hear me okay? While you're typing that in, we'll take a look. We've got number 1. We've got the spreads and condor traders. Very cool. And then number 2, folks that are doing covered calls. Okay, that's not surprising, because that's the way that most folks get introduced to the world of options trading, is by covered calls or attending one of those seminars. Okay. And then 3rd place, we got long calls and puts and naked puts. Okay. Super. Mike, let's see. Folks are hearing me okay, are they? Can hear Kurt's audio quality was better the other way. I'm sorry to hear that. I think we're going to probably stick with what's going to work as far as folks hearing me. Okay, Mike, let's rejoin the presentation here. This principle that I've been talking about, okay, it's top secret, and the reason that it's top secret is that it's in plain sight, and because it's in plain sight, nobody gets it. But it's important, okay? It's so important that once you do get it, it'll absolutely transform your trading results. And this is what I'm going to give away for free, and we're going to confirm it by the end of the program. You'll probably agree that what I've given you is, in fact, a secret that would transform your trading results, okay? But I'm going to ask something in return, okay? What I'm going to ask for is this, okay? We're going to make an offer at the end of the webinar for some products and services that will further enhance your trading, okay? Now, if you don't feel as though I've fulfilled my promise to you in this webinar, that we've given it away for free, that we're showing you a way to instantly improve your results, then don't invest, okay? Does that make sense? Go ahead and click that there, Mike. But if I do fulfill the promise, you should feel it's only honest to take advantage of my offer, okay? Provide a course that it's fairly priced and has an ironclad risk-free guarantee, okay? Would you say that that's fair enough?
Yes, I would.
Go ahead and type in if you think that's, yeah. I'd like for my audience members to type in if you think that's fair, okay? Now, we got piles and piles of you out there, and I appreciate your participation. Very good. Okay, thanks. Oh, and thanks, Casey. Casey made sure that I knew that he could hear me. I hear that's cool. Yes, yes. Another yes. Fair enough, says Ken. All right, good. Okay, Mike, let's go ahead and click here. And we're going to get started, okay? To understand how I came across this formula, it's important to know how I first did it in reverse, okay? I went to a seminar called Zero to Zillions. It cost me over $3,000 to attend the seminar. And what it was about, Mike, was it was about doing cover calls and calendar call spreads and also bull put spreads. That was the main thrust of it. And I did accomplish what the course said, except for I just got the order reversed there, Mike. I managed to take my life savings and turn it into nothing. And the reason is, it's the point that you had made earlier, okay? I went to the seminar and I learned the setup, but I didn't learn how to trade. Does that make sense, Mike? I learned the setup, but I didn't learn how to trade. One of the steps that I learned, of course, was this covered call deal. Let's click that screen, and we're going to take a look at, there's the covered call graph, the risk-reward graph. Now, Mike, we've talked about this before, where I said to you, if it was anything other than the stock market, if it was anything else, if I said to you, hey, Mike, I've got two investments. One of them has an unlimited upside and a limited risk, and the other has a limited upside but bears quite a bit of risk. Which do you think I should go into?
Well, in any kind of investing, I'd want to take in a position that has a limited risk, and then I still have the potential to earn higher income. I don't want to enter a position where my gains are limited and I still carry a lot of risk.
Right. And yet, when it comes to the stock market, a lot of times what we get talked into is this idea of limiting our upside potential, you know, taking on an obligation that says, hey, we have to deliver this stock at this price, and we think it's a winner. You know, the covered call trade, this symbol that I'm showing her, this logo, this chart that I'm showing here, isn't mine. I didn't make this. I pulled it right off of Options Express. Okay, and most folks would agree that when you buy stock, if you're mixing it with any other option, okay, if you buy stock, you're still bullish, right?
That's correct, yes.
Right. Okay, and now what if it turns out that you're right, and your stock doubles, or it goes to 50% higher, or even just 20% higher? When you sell a covered call, do you get to participate in that?
No, you don't. You get called away at the lower price, Kurt.
Right. On the other hand, if she crashes, if you turn out to be wrong, do you get to participate in that?
Yes, you do. And that's where the sorting machine aspect comes into play.
That's right. It seems kind of backwards, you know. You're sorting out your winners and hanging on to your losers. Well, Mike, I just had this crazy idea, you know, maybe we should do it the other way around. Okay, let's go ahead and click this screen a couple of times. We'll rapid fire through this, okay, because this is my story, okay? And I don't want to get too deep into it, but here's the deal, Mike. Just all I did was follow directions, and by following directions, what he said was, hey, if you want to really do well, buy your stock on margin because it'll double your return. So I bought stock on margin. I sold calls against, and I was using a search engine to find the highest paying premiums, and that happened to be in pharmaceutical companies, okay? And so I did. I found a really good one. Let's go ahead and click. Found a really good one called Lipo. And I bought Lipo at $17 a share, and would you believe that this was in May, would you believe that the June $20 call was selling at $3?
Looks very volatile.
This is good.
Mm-hmm.
Yeah, but you know, again, I had been taught to expect, you know, these. Actually, they weren't saying 3 to 6% back then. They were saying 4 to 10% returns per month. And here I found one that looked even better. You know, I was going to definitely get called out at $20, right? So I bought at 17, sold a $3 call. If she goes up to $20, and I make $6, $3 on the call and $3 on the capital appreciation, right?
Mm-hmm.
Oh yeah, sure. Okay, but then Lipo missed its FDA approval, and the stock opens at under $9 a share and starts heading down from there in huge volume. Everybody's getting out at once. Okay, so my broker Mike calls me. Okay, and it's not Mike Chupka. Okay. But his name is Mike. He gives me a call and says, look, Kurt, we need you to come in with some more money. We need to come into a margin call. And what do I want to do? Now here's the deal. Mike, I had gotten overconfident because the several months leading up to this, I had made money doing cover calls, and it always turned out. It always worked out.
Mm-hmm.
And so I had sunk everything that I had into this trade. I couldn't tell him that I didn't have any cash because in the first place, I kind of stretched the truth a little bit to get this full-service broker to allow me to do, you know, risky trades like this on pharmaceutical companies. I finally said, look, sell, just get whatever you can for it, you know. Like he was some kind of salesman, he could maybe get a higher price. Mm-hmm. Shows you how much I understood back then. He says, Kurt, I can't place an order like that. Do you want a limit order? And I said, well, yeah. You know, let's go 8.5 because it had been trading at 8 3/4. I said, okay, sell it all at 8.5. And then just as he's entering that order, this is what happens. He says, nope, you want 8 3/16, so I might be able to get that for you. I'm like, wow, what's going on? And we kept placing limit orders, and the price kept blowing down, down, down. And finally, I ended up placing a market order. Which was essentially when you place a market order, it's just a, you know, it's basically bend you over and give you whatever they feel like. I ended up losing everything, Mike. All but $400 of my life savings was completely gone. And I'm kind of reliving it right now. My voice is starting to shake here because, you know, I don't know. I think I'd rather take a physical beating than take a beating like I had in the market here. Okay. And to add insult to injury, just a few months later, Lipo is back up to full strength. Okay? In fact, it was actually higher than where I bought it. It was just a few months. If I had made that margin call, I would have not only kept my profit, okay, I would have gone above, I would have done better than just that cover call trade. Okay? But the thing is, I couldn't possibly know the future, and also, Mike, I didn't have the capital. I just didn't have the leverage. See, leverage had been used against me. And so, Mike, after this, I decided that I had ignored the one thing that I teach all of my martial arts students. Okay, the very first thing that they learn in class is how to keep their hands up, how to stay protected. Because after all, it's not necessarily the guy that can strike the most terrible blow that wins in a mixed martial arts match or in a street fight. It's the guy that can take the most punishment and still be smiling. And I got this weird idea. Let's click that screen. I got this weird idea that maybe this hockey is right uptown. So instead of having all the risk on the downside and a limited return, maybe we could go the other way around. You see, Mike, it's still the same expectation, isn't it? I'm still bullish when I buy stock.
Yes, we are. Mm-hmm.
When I buy a put to go along with it, it makes it safer. Okay, but here the reward is unlimited, and again, this isn't my decal, this isn't my logo or chart. This is what I pulled right off of the education site at Power Options. I'm sorry, at Options Express. Okay, and it's well known that this protective put option is a very good way to leave your upside open, and yet put a floor underneath your feet. Okay, now what's the objection usually, Mike? What's the objection to doing a protective put trade?
Well, when you first described the way that you were setting up your position to me, I told you that you were putting too much money into the position. You're buying too much insurance, and you have a low probability of ever earning a return because the stock's going to need to go up 10, 15, or 20% before you even realize a profit. I didn't see the point.
Right. And later on, of course, you did see the point when I invited you to a webinar. And that particular webinar, I think I showed like 3 different income methods and some message spread trades and some really complex stuff that we're not going to go into today. But you were sophisticated enough, you could pick it up, right? I mean, you looked at it and said, wait a minute, you can make money.
Mm-hmm. And we will show, later on we will show what we promised with the adjustments I made on the silver Wheaton trade as well. That are fairly simple. They're not that complicated, but they can be done, and you can earn extra profit, of course, on the position.
That's right. Will you have the capability? Can we jump out of this later on and get into Power Options? Good.
No.
Okay,
I have it. I'm sorry. I have it set up in slides, Kurt. We won't be needing to use Power Options to show that. We'll just show it on the slide presentations toward the end. Even
better. Even better. Okay, great. Okay, well, Mike, let's take a look at how to fix this problem. Okay, I had gone broke mixing options and stock the wrong way. For example, buying stock and then selling a call against got me hurt. And by October 2002, I began to mix them the right way. I would buy stock and also buy a put option and use that put option to limit my risk to very, very small amounts. I bought into Yahoo and eBay and Amazon. There's a company that's not in business anymore called Overture.
Mm-hmm.
It was OVER. Made good money on Overture. It eventually got absorbed by Yahoo, and bought them at very reasonable prices, and they obliged me by going up. Amazon was the best example. It went from $16.09 a share to $63 a share in about 13 months.
Mm-hmm.
And Mike, if I had sold the covered call against Amazon, I would have felt like a chump, wouldn't I? I mean, if I bought it at $16.09 and sold a $17.50 call, how much of that upside would I participate in?
Well, only about
$1.50.
Yeah, about $1.50, 2 or 3% perhaps.
All right, but she went up to $63 a share, and you know, that was kind of cool, especially having the floor underneath me. Okay, let's go ahead and click the screen. They went up in value. They went way up. You know, Yahoo did pretty good. And I was blogging. I was telling folks about this, and soon people were asking if I had written a book about how I was properly setting up these married puts and also doing nested trades, which we'll get to later. Okay. And of course, Radioactive Trade and the Blueprint were born. When I originally sold the Blueprint, Mike, it only had 4 income methods.
Mm-hmm.
Okay, we were doing variations on the covered call. Selling a covered call is income method 1, because it was the first thing that I ever learned. All right, and then income method 2 had to do with rolling that call at a profit. That's why it was an income method. And then income methods 3 and 4 had to do with manipulating the puts. But Mike, what I began to do was put out free publications. This was before GoToWebinar. put out a free publication called The Sketch, which is a mini blueprint, right?
Mm-hmm.
And it would teach folks, the proper setup, and it would also teach income method number 1. And Mike, still, I teach the general strategy for free, lots of different ways. We do it with PDFs. We do it with, on the site itself at radioactivetrading.com. We do it on this webinar. I've done it on my radio program, It's Your Money, okay? And we charge very little for an expanded version. The expanded version, the blueprint and the CDs and so forth, they cost, but they don't cost a lot. I learned very early on, if you give things a great value away for free, then amazing things begin to happen. Google was built on that, wasn't it, Mike?
That's right. Mm-hmm.
And now Facebook and Twitter and so forth. I mean, these are services that are free, but they have value. But then, even though it's given away free, then on the back end there are a lot of things where folks will find so much value that they'll end up wanting to pay you for more. And so that's what radioactive trading is built on. Okay, let's go ahead and click that screen. Over $500,000 in sales. Oh, let's go back. Sorry, go back one.
I'm sorry.
No, we went way back. And stop. Okay. Over $500,000 in sales later, I still believe it makes sense to show the value first and then make more available if people want it. Okay, and that's the offer that we'll do at the end. But right now I want to show you some things of great value. Okay? Now, Mike, I'm going to go ahead and run this poll here. Let's stay in this deal here. Would you rather have these two setups? Let's say you lose twice and you make money once. Okay? Would you rather lose 5%, then make 20%, and then lose 5% again? Or, next, click it, if we were to lose 8 times as much, make 8 times as much, and then lose 8 times as much again. If you were to lose 40%, then Mike, look at that, make 160%. When you make 100%, you double your money, right?
That's right.
Okay, when you make 160%, you more than double your money. You multiply your money times 2.6. Is that pretty cool?
Mm-hmm.
That's way cool. Okay, and then let's see. Then if you had a 40% loss after that, well then what? Let me just ask. I'm just going to ask everybody on the line there. Okay, what do you think would be better? The 5% loss and then a 20% gain, and then another 5% loss? Kind of flat, kind of boring, Or would you rather something real exciting, like, the opportunity that if you lost, you lose 40%, but if you make money, you make 160. But then, of course, if you lose again, then you lose another 40%. Which do you think you would prefer? Don't break out your calculators. I just want you to go with instinct right now. I'm surprised by these results. Are you surprised there, Mike?
I'm not too surprised. Are you? I mean, you are, I guess, but I'm not too surprised.
I am. Well, I'm surprised because a lot of times when we have options traders are very often lured by the idea of leverage. Okay.
Very true.
But something that they say. This is a saying that there are old traders and there are bold traders, but there are no old bold traders. And I think that that accounts for some of these results. Let me go ahead and share the results here, Mike. 88% said, I think I'm better off with these conservative losses. Okay, just keeping the losses down to 5%.
Mm-hmm.
And that's right. Okay, that's right. Here in a minute, we're going to show what these numbers would work out to. And 12% still thought that, geez, 160% return. Man, I'm into that. That works for me. Okay, but Mike, let's go ahead and look at what the results would be. Okay, the net result of the first option is a net gain of 8.3%. But if you took everything and you multiplied it by 8, okay, for example, if you used just strict options plays that were leveraged, and you could control 8 times as much capital, with a call, long call, for example. Well, geez, if you lose 40% and then make 160% and then lose 40%, you're going to have a net loss at the end. What if we went even higher than that? Okay, because some folks will say, well, 6.4% loss is based on 1/8 of the capital, so it's really not that big a loss. Well, geez, if you went 10 times leverage, which is that pretty available with buying long calls and puts, Mike?
Absolutely.
10 times leverage? Absolutely. If you had a 50% loss, then a 200% gain, multiplying your money times 3, and then another 50% loss, you'd end up with, well, 25% loss. Okay? And the thing is, Mike, if you're able to keep your losses low, this is the point that I'm trying to make. Okay? If we look at keeping our losses low, it makes it possible for us to be wrong more often than right and still make money. Remember, losing 5%, making 20, losing 5.
Mm-hmm.
That's a net of 8.3%. Pretty cool. Okay? So the lie of leverage, a lot of times folks will say, well, I like to leverage because, I can use less capital. But, Mike, leverage can be used against you too. Let me give you an example. I'm about 170 pounds,
mm-hmm.
5 foot 6.5 inches tall. Okay, I'm a little guy. And I've been able to go out on the mat and defeat opponents that were 200, 250. I even beat a guy that was 308 pounds once. He was no slouch. He had some muscle to him too.
Mm-hmm.
But the thing is, I had a lot of more experience and background on him. I understand principles of leverage. And I had him tapping out because of, well, the position I put his arm in. It's all 4 of my limbs against just 1 of his arms. The point is, I don't fear fighting a man that's bigger than me because I understand the principles of leverage. On the other hand, what if that same fellow, what if the 308-pounder had the same background and experience that I did?
Well, then you'd be in trouble,
I
perhaps.
I wanted to shake his hand. Yeah, I just want to shake his hand and be a nice guy. The fact is that leverage can be used against you, and there's nothing bigger than the market. Okay, you are not bigger than the market. So we just got to understand that. Okay. Now, Mike, haven't gone through that. Let's go through the structure of a radioactive profit machine, which I believe is the proper way to set up a married put trade. Okay. You see, here in this zone, we've got green is that stock going up, and red is the stock going down. Now, Mike, if you just own the stock and she goes down, your losses are 1-to-1, right?
Mm-hmm. That's right.
All right. But with the put option protecting you underneath, and we're going to get to some numbers here in just a minute, but I just want to get concepts out of the way. Let's go click that screen and look at the break-even line.
Mm-hmm.
Okay. What we have here is a structure that if we buy the stock and also buy a put option, there's only a very small amount that can be lost. Click it one more time. This this area here between the dashed line and then the hard bottom there, the hard line at the bottom, that's your floor. Okay. But then on the other hand, your profits can be unlimited. Okay.
Mm-hmm.
So let's go ahead and take a look at your SLW trade here, Mike. We've got SLW shares. Now, you picked this up on May 21st.
That's right. Now, do you want me to transfer over to the other slide at this point, the other slide presentation at this point?
No, let's go ahead and stick with this for now, and then when it gets to income method 4, can we swap over?
Okay.
Does that make sense?
All right. Yeah, that's fine, Kurt.
Okay, cool. And you know what, Mike, I bet you got something pretty slick. But I know my talking points on this part, so let's go ahead and start here. All right, so SLW, you picked it up at $17.20 a share.
That's right.
Okay. And at the same time, you picked up a December, now that's 7 months out in time, a December $20 put option for $4.30. Now, what was the objection that you gave me when I told you that this is how I trade, and you looked at that and you said, well, I don't know about that.
Well, the first time you
know,
called up,
yeah,
the first time you called up and you asked me how to find these positions historically, and I saw what you were doing, I thought that, well, this doesn't make any sense to me. You know, usually when you do a protective put, you buy an out-of-the-money put that's 1 month out for a low premium. In this case, you're adding $4.30 on top of the position, and, you know, you'd have $21.50 invested. You're not going to make a dime until the stock's above $21.60. I don't know why you would do this on a stock trading at $17.
Right. And that's the argument that I hear a lot of times, Mike. But let's go through the math.
Mm-hmm.
The total invested there is the $21.50, and we're guaranteed to be able to get out at 20 if something goes horribly wrong. So the amount at risk is $1.50. Now, out of that $4.30, we're going to get most of it back. So is it really that expensive?
Right. The cost for us, the time value cost, is only $1.50 on the position, which works out to be 7% on this particular trade. And this is the initial setup. This is the setup that we use every time we open stock. This is the radioactive profit machine. We're going to purchase shares of stock and look to purchase the in-the-money put option several months out in time. And, of course, the philosophies behind why we're setting it up this way are described in the blueprint.
Right. Now, Mike, you've been in silver Wheaton since May. Can you imagine trading silver Wheaton with a 7% stop loss order?
Well, it'd be a tough position to do, especially if you got into it recently, because the stock tends to move a little bit. Silver Wheaton has a little bit of move. It's in the right industry right now, but with a 7% stop order, which is essentially a market order, telling the market, hey, get me out of this position as soon as this is triggered, and then you don't have any say in it. Now, if silver Wheaton goes down in price from this initial entry point on May 21st, I can choose to close the position and take only a limited risk, or I can choose to make adjustments and continue to make the trade.
That's right. Now, another argument, okay, another argument is that we're starting underwater. For example, you bought the stock, you bought the put, man, you just lost 7% because the 7% is what's at risk, right?
That's
well,
right.
Is that how it really works out?
Well, no, because first off, I'm not going to realize the 7% risk unless I hold the position all the way to expiration and make no adjustments. As the stock moves,
the stock goes down.
And the stock goes down. If the stock stagnates, that put's still going to retain a lot of its value. So I'm not going to realize the 7% loss until closer to the expiration date if the stock moves down. But if the stock moves up, I can not only do certain income methods that we're all probably familiar with, just selling a call against it to generate some income, but I'm also going to be able to take advantage of adjusting the put if the stock goes up or goes down.
That's right. Okay, and then you're getting into income method number 3, 4, and 9 there.
Mm-hmm.
But the fact is, a lot of folks believe that once you buy the stock and the put, it's like driving a new car off the lot. You know, when you drive a new car off the lot, it loses 20% of its value just like that.
Mm-hmm.
But honestly, Mike, moments after you entered this position, you could close it for about the same.
Yeah,
right?
I could have sold the stock for about. Yeah, I could have sold the stock for about $17.20, and I could have sold to close my put for maybe $4.10, $4.20, for example, and only lost 10 or 15 cents.
Right. Okay. So that total amount at risk, that $1.50, that's the maximum over a period of 7 months. It's like you're paying about 20 cents per month for insurance policy.
Mm-hmm.
Okay. But let's see what happens. Okay. Let's take a look at the next screen. You see, we start out with it there. When I say we, I mean Mike. This is Mike's trade. And then silver Wheaton went up.
Mm-hmm.
Okay. And then next page, we're going to have income method number 1. Now, income method number 1 is selling a near-term covered call. You've got insurance all the way out to December, right?
That's right.
Right. And what you did was you sold a covered call, and what was the strike price?
It was the 21 strike. I believe I sold it on 6/28 when the stock was trading at around $20.50, about $20 per share.
Okay. Now, your total amount invested for both the stock and the put was $21.50.
That's right.
So by selling this call, you generated a little bit of income, right? Let's go ahead and see. It was $1.48, and by doing that, you took on the obligation temporarily that you would deliver silver Wheaton at $21 if it was trading higher than that. Right?
That's right.
Okay, but what is our cost basis? I mean, the cost basis had been $21.50. Now it's $20.02. Okay, so if you deliver those shares at $21, do you make a profit?
Yes, I would have a profit, and I'd still, even in addition to the 98 cents, because I'd get called away at 21, in addition to that, the put would still have value in it as well.
Right, the put option itself would still have some worth to it. So you're looking at definitely, you know, a 5 or 6, 7% return. I mean, I see about almost 5% in selling the stock at 21 and keeping that premium. Okay, but you could also sell your put and do better. But Mike, what happens is you've got a guaranteed exit. You can get out of the stock for $20 a share, and your new cost basis is $20.02 a share. So what's your risk?
Well, the risk is 2 cents on the position. I'm only risking 2 cents now after one adjustment.
Poor baby. Okay, so that's the first adjustment. Okay, that's income method 1, and that doesn't necessarily mean you don't have to do them in order, do you, Mike? You don't have to do 1 and then 2 and then 3.
No, absolutely not. It's based on what you call the SIGA model for each position. Now, at this time, when I did income method number 1, there was also an opportunity to start off with income method number 4. That we might show in a couple minutes. And income method number 4, I could have done a little bit differently. I wouldn't have exactly bulletproofed the position, but I might have been in the same situation with an unlimited upside profit. I think I would have been risking 20 to 30 cents on the position if I applied income method number 4 at this time.
Right. Okay. So now this call expired worthless, and you're left with a almost bulletproof position. Let's go to the next slide here. What happens with this setup? Okay, the income methods reduce the gap. We start off on the left there with a gap. Go ahead and click the dealie, and we should get a dotted line. Okay, and that's the original. But then by doing an income method, we reduce that gap. Okay, and then next screen. Once we reduce that gap enough, okay, you can actually reduce that gap to less than 0 by repeated or sometimes even just a single income method. You start out with a small gap. Go ahead and click it, and continue to reduce it by way of the income methods, and you're going to end up with, look at that, Mike, we've got unlimited upside potential, and the floor is above break even. So what do we call that situation?
Well, that's bulletproof, Kurt. We have an unlimited upside, and we can't lose any money on the downside.
Right. Unlimited upside, can't lose any money. Okay. Now, Mike, is this a good place to exit to your slides so we can also show income method 4?
I think so, because I also want to show something else. It's I forgot to mention something to you when I sent the slides over. The call didn't expire. I actually bought it back for 3 cents on August 20th.
So you ended up with a nickel risk.
That's right. That's right. But I'll show that as well.
Okay, very good. Mike, right now I'm running a poll. I just wanted to ask a question of our folks that are on the line. If they're happy with their trading results for the last 12 months. And then, Mike, I'm going to have an immediate follow-up of that question. These are actually leftovers from the last presentation that we did. Okay, I'm going to have some new ones pretty soon, some new questions. But I think it's still profitable to do this interaction with these particular questions. I think it's going to be profitable to our audience. Because I'm using the Socratic method, I'm going to teach by way of asking questions. So we'll give it another few seconds, and I think I'll closer 3, 2. If you haven't got your vote in, do it now. 1. Okay. Mike, we've actually got a pretty high instance of folks that are happy with their trading results. That's marvelous. It's still not high enough for me, but that's high. We've seen it in the teens, We've even seen it in the single digits. We've even seen it 0, where we've had nobody happy, right?
Yes, and there's something that goes along with that, and you unfortunately didn't get to see it, and I didn't get a chance to review it with you. Our first poll, we had 48% of our attendees doing the free materials, 23% thinking about buying the blueprint, and 50% currently own the blueprint. And that was when we first started the presentation. Yeah, that's when we first started the presentation, the first 2 minutes before you logged on, when I think we only had 40 to 50 attendees, and now we're up to 100 plus.
Right. Okay. So we had 50 then. We've got 111 right now on the line. Actually, I think you and I count, so it's 109. So we have 109 folks on the line, and when we had 50% of them said that they had the blueprint.
That's right.
Kind of suspicious, isn't it? Okay. All right. Well, let's go ahead and hide the results there. Here's what I'm going to do. I'm going to ask if you could keep your wins from last year, but all your losses you were able to reduce by one way or another. I mean, if you were to use a time machine and go back, and you couldn't not make a bad decision, but you could just turn a losing trade into a trade that only lost 6%. Okay. What if? Would you have answered differently? Would you have said, yes, I'm happy with my trading results now? Or still said no but been closer to yes? Or would you have still said no? If you happened to be in the no category before, would you still say no? If you're in the yes category before, would you still say yes? You know, we got to make sure and clarify that.
Got it.
All right. Let me slide this out of the way so I can see what's going on. There we go. Oh, my goodness. That's something else. I'll leave this up for just a few more minutes because I want to get as close to 100% participation as possible. Leave it for another 10 seconds. Mike, this is dramatic. It's dramatic. Let me go ahead and close that poll. Whoops. How do we do it? Close that poll and share the results. Mike, 75% would be happy with their trading results. That's 3 times as many, right?
Yes, it is. Absolutely.
And 13 would have said still said no, but been closer to yes, and that leaves only 12% that would have still said no. Now, I'm going to say that if they would have still said no, Mike, then that means that they lost less than 6% on their trades, right? So if you're losing 5% or less and still you're not happy, I think you might be losing it too often, and that's also a factor. You might be staying in trades and nickel and diming yourself, not staying in trades long enough to see them mature. And so that's also a really good principle that we're going to have to articulate in one of these webinars, Mike. Not just managing the losses, but managing the frequency. Okay? Because if you have 5% losses in a row, it's suspiciously like losing 50%. You know what I'm saying? All right. Okay, so, but in all, 88%, okay, 75 plus 13, would have been better off, okay? I'm going to ask how much better off, okay? And then we'll launch into income method 4 with Silver Wheaton, and then we'll make our offer, okay? All right. Mike, just a little side story. I was in Colorado Springs in June doing a seminar, a live seminar with the options trading group there in Colorado Springs. And one fellow raised his hand. He says, try $30,000. And I said, sir, if you had managed your risk down to 6%, you would have saved or made, you would have had $30,000 more to your bottom line last year? He says, well, no, that's just one trade. He was talking about his worst trade of the year. He would have saved $30,000 if he'd only been following the risk-limiting principles in the blueprint. Okay, Mike, whoops, yep. Okay, 3% didn't get it. They said, I don't see how that would help at all. 12% would have saved $300, and I chose that $300 figure for a reason. Let's see. 18% would be ahead by $1,000 to nearly $5,000, and the lion's share, Mike, 65% would have saved or made $5,000 or more. Another 3% see the possibilities here, Mike, of being able to have very small losses and have your capital left to buy at the bottom.
Mm-hmm.
For example, I was managing for a friend. I was managing $350,000 of his money, and he had about the same amount in mutual funds. In November 2008, he had lost more than 40% in his mutual funds. Guess how much I lost him, Mike?
Probably around 3.5%, 4%, maybe 5%.
It was about 3.9%.
Mm-hmm.
Okay. Now, if you lose 3.9% in one of the worst bear market drops, that means you have 96.1% of your capital left.
That's right.
And you can buy stuff with that, okay, and buy it on a bargain. Okay, and so 3%, I recognize that, but 65% would have saved or made $5,000 or more. Mike, what we've shown today, we've shown the value of limited risk trading, haven't we?
Mm-hmm.
Okay. Well, Mike, let's go ahead and take a look at your silver Wheaton example. Now, you had done this.
And I just wanted to review and go back to where we were.
Shared.
Right, just wanted to review where we were. So on 6/28, we opened the August 21 call for $1.48, and if the call expired, the new at risk would have been 2 cents. We saw that a moment before. This is what the profit and loss chart looked like at the time. With the stock at 21.45, it jumped right above that afterwards, but then it came back down shortly afterwards. But this is what our profit and loss chart looked like. Notice there's our, oh, I'm sorry, let me go back. I'm sorry. There's our $2 at risk now, and the potential maximum return if the stock was trading right at 21 on August expiration would have been about 11.6%. So we turned it into sort of a little collar spread, and then it tails off at the end because we did cap our gain. That's sort of the problem with, well, I don't want to say the problem, but that's one of the issues with income method number
one. One of the caveats.
Yeah, and the caveats, exactly.
Yeah.
Now, as I mentioned, what happened is that we had our initial risk of $1.50. It was 7% on the RPM. We sold the August 21 call for $1.48. That's income method number 1. Now, the new at risk if the call expired was 2 cents, but on expiration, the stock had gone up to about 21.40 a couple days before expiration. I didn't want to buy it back. I waited till about Friday, and I was able to close it for about 3 cents. But we still kept $1.45 of that initial premium, right, Kurt?
Right. So you've only got a nickel
Right.
at risk. Essentially, what you've done is you've reduced your cost basis from $21.50 down to $20.05.
That's right.
Am I tracking? Am I right?
That's right.
Okay.
Mm-hmm. We're going to look at it a slightly different way, but it's very similar. So here we go. What we did here is you notice up at the top, this is the same position. We have our December 20 put at 430. But that $1.48 did reduce the total cost to $20.05, or reduced our stock cost, our effective cost, to $15.75. And here's that profit and loss chart. A different way of looking at it, but Kurt already showed this. What have we done? We've reduced the risk to only $5 total on the position. That's $5 per 100 shares, or 5 cents on the position. Now, this was done. This screenshot, I'm sorry, was done when the stock was trading at $20.64. When this was actually done, the stock was trading right at about $21. And we bought back that 20 call. Now, what are we going to do next? First, we want to review what are some of the common mistakes with income method number 1, Kurt. I like to review this because everyone who's researched options might think that, oh, I see what Mike and Kurt are doing. They're buying an in-the-money put. So I can just go ahead and do that now, limit my risk to 5%, and I'll sell the at-the-money call right now and cancel most of that. That's a problem, isn't it?
Yeah, because the fact is you take on an obligation. You've got to understand, and there's principles in the book, that'll show this, the catastrophe report, for example. But if you sell a call at too low a strike, sure, you're going to capture more premium. But you take on an obligation that can turn into a problem.
Mm-hmm. And you don't want to sell too soon or with too little premium. And then, of course, just some basic general rules of thumb. What we would have done with income method number 1 is once we open the married put, once we open the RPM, we're going to wait for the stock to move. I opened the stock at $17.20 and bought the put, but I waited for the stock to be trading around $20.50 before looking to apply an income method. We want to wait for the stock to make a move. General rule is a gain of 5 to 8%, or if the stock happens to move up to your put strike price. And in my opinion, what I've seen so far, but it does depend on the stock and it does depend on the movement, but typically the best opportunities occur when the stock's trading right at the put strike price. That's why I entered this call when the stock was trading at around $20, $20.45, because I had the December 20 put. So that's just some free stuff there. It's talked about in the sketch, but this is a little bit further. Some of the things to look for and some of the things not to do with income method number 1. Regarding silver Wheaton, now what? It continues to go up in price after we close the call. Stock's at around $21. Next Monday after August expiration, it's around 21. It's between 20.80 and about 21.40. But then it starts to move up again. Now, do we want to use income method number 1 again? Or do we want to use a different income method to bulletproof or potentially earn extra income? Well, this is where we'd consult the blueprint and use the Power Options tools tracking the position in the portfolio to see what opportunities were available. Now,
because you wanted to keep your upside unlimited, right? You didn't want to have to sell calls all the time.
And that's right, and I only did it this first time because I could get close to bulletproof. When I first sold that August call, I did have a market order in place, or limit order, I should say, to sell the call at 150. It didn't get filled. I lowered it down a little bit, and then I finally got filled at 148. I really did want to get $1.50 for it, but they weren't budging. So, where do we stand right now? Well, we're going to subtract that $1.45 off of our initial stock cost of $17.20. So our new effective cost per share on the stock is $15.75. We have that December 20 put at $4.30. So as we saw, our total invested is $20.05. We still have the 20 put in place, so we're only risking 0.5%. Now, with income method number 4, what we're going to look for is there's a way to lock in profit by adjusting the put to a higher strike. Now, what I was shown on the Power Options tools is I could sell to close my December 20 strike put for $1.10. Now, at this point, this would have reduced the total cost on the position to $18.95, but I don't have a put in place, right? This is just looking at the effective cost per share. Now,
right, you're going to want to put in place.
Right, and then I'm going to change my insurance, and I'm going to buy to open a December 24 put at $2.70. Now, this is an income method, Kurt, but if I sell to close my 20 put for $1.10, and I buy to open a higher strike put for $2.70, did I generate a premium for doing this?
Well, no, you didn't. You actually paid to do this because, and Mike, did you do this with just one trade? Was it one spread trade where you close one leg and open another?
Actually, no. If I had done this in my
in other words,
right, if I had done this in my Options Express account, I would have done that. This was actually in my Fidelity account where I did have to enter it as 2 transactions, unfortunately.
Okay. Okay. So you paid 2 small transaction fees, but the point is you received $1.10, and you paid $2.70, so that's a net debit of $1.60.
Right.
But by paying $1.60, you raised your guaranteed payout from $20 a share to $24 a share. So I think it was worth it.
Well,
why don't you walk us through the math of what happens next?
Right. So I had a cost basis here of $21.65 now. We lowered it to $18.95 by selling the original put. Paying $2.70 for the new put gives us a new total cost of $21.65, but now I'm guaranteed an exit of $24. I have a guaranteed profit of $2.35, or about 11% on the position. Now let's take a look at that transaction. See here, I lowered my cost basis on the stock to $15.75 because of the first income method number 1 position that we kept the premium for. I had the December 20 put for $4.30, and then here I simulated selling that for $1.10, and then buying the 24 put for $2.70, and then down below we see that we have the gain, a guaranteed profit of $2.35 no matter what happens on the downside, still have an unlimited upside, a guaranteed profit of 10.9%, and it can still gain more profit.
So poor baby, you've got to sit on that knowing that you're going to make at least 10.9%, but as it's going up, you may make more. Now, Mike, have you done other income methods since? We don't have to go into detail of it, but have you done other income methods?
Well, I'll just sum it up real quick, and I have 2 slides that just sum it up real quick here. In September, I was able to use income method number 1 and income method number 2, where we sold the call and then I made an adjustment, and I generated 70 cents of premium by selling a call and then buying it back. So this lowered the effective cost per share that we had on the previous slide here. That reduced our effective cost per share on the stock to $18.25. Now, it did move up. Of course, when we made this adjustment, it would have changed the effective cost per share on the stock to about $18.95. But we lowered that down by 70 cents. And then on September 8th, I was able to use income method number 4 again because the stock was trading at about $26.50.
Oh, boy.
So I closed the December 24 put for $2.20 and bought the December 27 put for $4. So I again paid a debit of $1.80 here, Kurt, didn't I?
Yeah, but it's a wonderful trade because what it is, Mike, is you didn't predict anything. You're responding to what the market has already done.
That's exactly right.
And what you've done is, yeah, you spent $1.80 to guarantee yourself a $3 higher payout.
Mm-hmm.
To my thinking, that's an instant 66% profit on that trade. You know what I'm saying? Because you're spending $1.80 to get $3.
$3. That's right.
That's marvelous. Okay,
and then
so where do we stand now?
Here's where we stand. Now, the effective cost is $18.25. Now, what happened there is, remember, we had lowered it to $15.75 essentially with that first income method number 1. We added the cost of the debit we did from the first income method number 4. When we rolled to the 24 put, that actually increased the effective cost per share on the stock to $18.95. But then I showed just briefly we did income method number 1 and then bought it back again in September. So we lowered the cost of our stock down to $18.25. That's the new effective cost per share on the stock position. We had a put at $2.70, the December 24 put at $2.70, sold it for $2.20, and then paid $4 for the 27 put, and this is where we stand right now. The stock, this was done 10 minutes, this screenshot was done from my portfolio 10 minutes before the webinar. So the stock was trading at $26.42. I have a 27 put open, guaranteed a profit of $425 per 100 shares, or 18.7%. And what about the upside, Kurt?
Well, the upside's still unlimited. You don't have any short calls limiting your growth. This is truly what we were, what we were sold, what I was sold, Mike, when I went to these covered call and spread trading seminars, was 3 to 6% monthly income. Now, how many months have you been in this trade?
I opened it on
You've been in it since May?
Yeah, I opened it on 5/21, so I've almost been in it for 5 months now.
Okay, so almost 5 months. You're guaranteed 18.7%?
18.7%, which roughly translates into a monthly profit of about 3.6, 3.7%. Which matches my goals.
Right, and the good news is if something drastic happens, I mean, if some airplanes hit some buildings, okay, you're going to make an 18.7% profit no matter what. But if the market keeps going up, and SLW keeps going up, you're going to reap the rewards of it going up.
That's exactly
you're
right.
Probably make more than 18%. This is exciting. It's really exciting. I like to see it when somebody's using these methods, and I learned something. I do. I think I need to be rolling my puts a little more often here.
Well, it's a different, and you address this in the blueprint. We talk about it in the blueprint. There are different kinds of traders, and the one fantastic thing about the blueprint and this method is that, Kurt, actually, I don't know if you would have entered Silver Wheaton at the same time I did. You have a specific listing of rules that you look for that you describe in the blueprint of what you want to see and what you're looking for. At the time when I opened this trade, Silver Wheaton matched my criteria, but it might not have matched yours. You can apply this different ways. We have radioactive customers, radioactive traders, who are using this only on ETFs. We have some that are using it on more volatile stocks, taking a little bit more risk on their tolerance and what they allow in the married put setup, but taking advantage of some of the volatility shifts in the market. You can apply the radioactive techniques discussed in the blueprint to an existing stock selection process that you have, Or Kurt describes what he looks for specifically when he's opening a position as well. It's very flexible. And then you have 10 different income methods described in the blueprint, 10 arrows in your quiver, 10 tools in the toolbox to set the position up from that original risk to guaranteed profit. Doesn't have to necessarily use income method number 4 and income method number 1. Kurt, you've been able to do this with income method number 5s and income method number 6s.
Right. Yeah, 5 and 6 are my babies. That's what I like to use more than anything. But you know, it's good to have, like you say, more arrows in your quiver. You know, things that respond differently in different markets and to different people's goals.
That's right.
If you want short-term income or if you want long-term growth, you know, or a mixture of both, the blueprint has got it all. We're able to do it. And Mike, maybe we should get back to the presentation because it looks like we got about 3 minutes, and I need to make my offer. But what's exciting about this, Mike, is at the very beginning I mentioned that I studied the lives of great traders and found that they all had diverse and varied ideas about what kinds of things to trade, what kind of time frame they ought to trade it in, and what kind of technical entry and exit signals they should use. They all had different ideas, but they all had this one thing in common, and that was a practical method for cutting losers short and letting winners run. And if the blueprint's not that, it's not anything. Okay, it's a method. It's a money management method rather than a trading method. The only reason I call it radioactive trading is because people know that since trading is in the title, it has something to do with trading the stock market. But it really should be called radioactive money management, because that's what we're doing. Okay. Well, Mike, let's go ahead and make that offer that we promised at the beginning. Okay. The offer of what you get, what it'll cost, and what you risk.
Okay.
So here's the idea. Okay. The blueprint is 250 pages of how to trade married puts. A lot of folks have jumped on the bandwagon within the last few years, last 3 years especially. But Mike, I began doing this in 2002, wrote the book then, or began writing the book then. I actually published it in April of 2003. And since then, I've had the opportunity to network with people from over 25 countries that have written in and told me about their experiences and what they're doing. And we've developed it from 4 income methods to 10. Nobody else basically is doing all the things that are in the blueprint. Okay? So that's one thing you get. Another thing that you get is these 3 bonuses. Okay? Bonus number 1, a fast action guide. The fast action guide is something that I'll be emailing you, and it's how to get started quickly with radioactive trading, with how to find and how to manage these kinds of trades, and a recommended course of action. Another thing is the Foundations of Radioactive Trading CD. We've had a number of folks pick that up and tell me that it was worth over 10 times the purchase price. Okay, we sell it for $89. I had a fellow write me in here recently. He said, I put on every trade, every single trade according to those guidelines. And Mike, I came up with this later on because I realized that some folks weren't just trading serially, you know, one stock after another. Some folks were trading baskets of stocks, you know, 5 and 10 and 15 different positions. And so we wanted to show how to spread risk properly throughout all those different stocks. Okay. Also, Mike, you're the Director of Education over at Power Options. The Power Options subscription, we don't have the time to show the power of it, but Mike, let's just say that it saved me huge amounts of time as far as not just the search, but also the adjustments. You know, just looking at it and comparing all the different income methods, and should I apply an income method right now, and if I do, what will the picture look like after I do? You know, the Power Options tools are invaluable. It's the most powerful thing on the market. It's the only thing that's customized to be able to use the radioactive trading adjustments. Okay, so that's those are 3 bonuses. That's what you get. Okay, what it'll cost? It's $289. We don't want you to come to a weekend course and pay $3,000 and then come to a master's course, it's $5,000. We don't want you to buy a lifetime membership that's, $15,000 and then you can get coaching or whatever. Okay. It's $289. If you live in the United States, the shipping is $11, so that makes it an even $300. Okay. And Mike, I'm just going to flash this back up there again. We had 12% say that they would have saved at least $300 if they had just known the free stuff that I showed today.
Mm-hmm.
Right? If they just known the free stuff. 18% would have been 1,000 to 5,000, and 65% would have saved or made $5,000 or more. So, Mike, 12 plus 18 plus 65, that's 95% of the folks on the line would have had the $300 in value or better. Okay? So, what do you risk? Nothing. Nothing. Nada. If you're not happy with the contents of the blueprints, you know what? Send it back, and you can keep the bonuses. And for a very limited time, the publishers have agreed to do a 100% money-back guarantee. The argument ahead of time was, well, geez, if we do that, then everybody will just get the book, learn the stuff, and send it back. And I said, guys, you know what? Most people are more honest than that. If they're getting the value, they'll keep the book. But if you don't think you're getting the value, if you don't think it's worth more than what you spent, why then send it back. We definitely could get it to someone else, and we want it. We want to do that. Okay. Okay, Mike. Let's hit the next slide, and I think we'll wrap her up here. We're about 2 minutes over the time that we said. Let's see. There are how many callers at this time? We had at one point over 130. We've got just over 100. We can only open this to 87 more blueprints because we sold 13 of them. Okay, and we can't give out these bonuses all the time. And I don't know if my publishers will go for it and continue to guarantee. When you think of it, Mike, 100 blueprints at $300, that's $30,000 worth of inventory out there that might be returned, right? So they've got to look at, they've got to use their own judgment, as far as risk versus reward, right?
Mm-hmm.
Okay. But what's the risk on our callers today if they take care of it today before all the blueprints are gone?
What's the risk?
Zero, right?
Yes, it's zero.
Yeah, what's zero? Okay, it's going to be zero. So I don't know how much longer we'll be able to do that, but we should be able to handle everybody today. Okay. All right, and let's go ahead, Mike, hit that next slide because I think it has some contact information. There we go. Oh, I should mention support, okay? Anybody that owns a blueprint, if you ever have a question about any of the 10 income methods, just drop a line to support@radioactivetrading.com and somebody will get back to you with a detailed explanation of what you need. Okay. Okay, Mike. I think we're there. Were there any questions that came through that weren't answered by the?
There were a ton because of the way that we were running this presentation. Unfortunately, there were a ton of questions that right now we have other ones that need to be addressed. Ed just wanted to know, where do you order the blueprint? Well, Ed, just go to radioactivetrading.com and click on the Products tab in the upper left-hand corner. You'll see the information there, and you'll get to take advantage of the free offers. Let's see here. Is the bonus CD a new offer? Might be a clincher for me, Joe. Yes, this is the bonuses that Kurt showed there. This is the first new thing that we're offering. So you get the money-back guarantee in the blueprint, his quick action guide there, the CD there. It was the Fort, the Foundations of Radioactive Trading. You can get more of a description there, also on the products menu as well. And then the free first 30 days of Power Options. That is all new, Joe. And just order it directly online. You won't see a special link with all of the bonus offers. When you go to order the blueprint online, we'll take care of everything in the background and make sure you get your bonus offers as well. Let's see. Is it Lidwee?
I see one. Larry asked, can these income methods be used in an IRA? Almost all of them can be used in even the most stodgy IRAs, like with a Charles Schwab or a Scottrade account. The ones that can't, we can suggest some other brokers that will allow them. Bill O'Donnell says only 10 times the value. How about 100 times the value on the Foundations of Radioactive Trading disc? Thanks for that endorsement there, Bill. Bill says that that it's worth 100 times what we charge for it. We're giving that away free today. Let's see. I trade only options, no stocks. Will radioactive trading help here? That's Mohammed. Mohammed, it'd be very good for you to know all 10 adjustments, and you could apply it to a long call, but I highly recommend that you look into the reasoning behind using a put in stock instead of a long call.
Lidwine,
any other questions?
Yeah, I'm going to have to, Lidwine, you had several questions, and I apologize I couldn't get to them during the presentation. What I'll have to do is I'll email you separately regarding your question on the blueprint there, and let's see what your other question was, and regarding the bonuses as well. I'll send you an email, Lidwine, regarding that. Byron had a couple questions earlier, but he wanted to know what determines the strike and what month put to buy. That's discussed in the blueprint. There is such a thing as going too deep in the money and taking on too much risk there, Byron. And I think you also had a question on volatility. Hold on one second. I'm sorry about that. Hold on one here. Let me just go back. Oh, I'm sorry. No, it was Ron's question. Is volatility important on the put? It will lose value quickly, and if the stock price does not move, the total position will lose. Well, you still can't lose more, Ron, than what you initially had. If I opened that silver Wheaton position with a high volatility and had a 7% at risk, even if the volatility collapsed, you know what? I can't lose more than 7%. That being said, there are some positions I entered when I saw a volatility collapse, and I realized that I was a little bit behind the 8 ball by 1 or 2%. But as soon as you open that position, no matter what the volatility does, you're guaranteed that you can't lose more than that initial at-risk amount. That's already priced in.
Very good. Rick says, it seems that you limit your upside when you sell a covered call. Well, yeah, you do. And that's why we'll only do it under certain circumstances. And even then, only for a limited period of time. That's why we only do short-term calls, if we do them at all, because the income method number 4 trade, that doesn't involve a covered call at all, does it?
That's right.
And KC says, that is so neat. And I think it's right after you showed your income method 4 adjustment there, Mike, where you took it from bulletproof to more than bulletproof, trading one strike price for another and guaranteeing yourself a higher payout each time.
Mm-hmm.
So that's marvelous. Okay. Mike, I've got, I don't think I'm getting all the questions that you're getting. I'll tell you what, folks, if your question was not handled and you desperately need that question to be answered before you make a decision to pick up the blueprint or not, why then send that question to support@radioactivetrading.com. Somebody will get back to you, within minutes usually. 24 hours is the most. And okay, Mike, I'm going to go ahead and sign out. Are you going to stay on, or are we pretty cool here?
Yeah, it's, Rick, I believe Kurt answered your question. Bill, I believe it's Bill S. Please send us an email to support@radioactivetrading.com, and we'll give you a recap of what the free offer is today. It's buy the blueprint today, get the free Fort CD, get the quick action guide that Kurt's going to send you via email on getting started, and also a free month of power options. That's the offer, but if you send us an email, we'll try and send you an email after the presentation where we'll give you the specifics there.
Super. Okay. All right. Hey, I want to thank everybody that's still online. I want to thank you for coming. And thank you, Mike. This